Hi, good evening. This is Brent Carlson with Corporate Capital. Thank you so much for attending our webinar tonight, February 24, 2016. I really appreciate everyone attending, and hopefully everyone's enjoying the monthly webinars that we're putting out here at Corporate Capital to share our knowledge and a message with you. Tonight, the webinar will be on tax strategy. We're in the heart of tax season. And as business owners, we know in order to grow our company, it's so important for us to have a plan and to make sure that we do everything we can to save as much money as possible to grow our business. So again, thank you so much for attending the webinar tonight. Before the things we'll be covering will be getting familiar with the U.S. tax prep system. We're also going to learn about corporate capital and some of the strategies that we have in place. And third, just start saving money. You know, it's so important, as I mentioned, to save money for your business. Before we begin, I want to ask everyone a question. Do you feel that you are in complete control when it comes to your taxes? Of course we should be, but do you feel that way? Do you know exactly where you're at down to the penny? What I consider to be the most fundamental business move you can make, and it doesn't matter if you are a trucker, landscaper, you have a bakery, you're a doctor, lawyer, it doesn't matter what industry you're in, pre-tax planning is the most important thing for your business. I also want to let everyone know that tonight we have a special treat for you. I have asked Bob Brome to answer some of the frequently asked questions that we get in our business each day. So I look forward to hearing from Bob. Again, we'll talk a little bit later about the pre-tax planning, but before we get there, I want to share with you some staggering statistics, just some numbers that when I came across, I was absolutely shocked. 80% of businesses will overpay on their taxes. So it's not a matter of if, it's a matter of when we're going to overpay. And that's according to the IRS, 80% of businesses will overpay. According to Forbes magazine, 93% of businesses will overpay on their taxes. So just a huge number, a number that needs to be addressed and needs to go down. And that's what I want to share with you tonight. And it leads to a question, why? The obvious answer is when you get your business or individual tax return done, there's zero tax planning. They simply take your W-2 and insert numbers without even going over the books. And you know, some of the companies out there, like the big H&R Blocks and TurboTax, they have tax preparers that you don't have the same relationship with, you don't work with year in and year out. And so with the zero tax planning and just taking the W-2s and 1099 and inserting the numbers without going over the books or other financial considerations is absolutely going to make you overpay on your taxes. Also, you know, the problem is when you sit down with individuals who really don't have tax planning mentality, they go over, you know, some questions with you, they fire questions, you answer them off the top of your head, they take that, insert the number, and then they spit out the return. And that is just what we call reckless accounting. And a big reason businesses and individuals overpay on their taxes is right there in front of you. The U.S. tax code is more than 70,000 pages long. 70,000 pages. You must have a professional, you must have a team of which who goes to these courses each year, who constantly studies the tax code, and imagine one individual trying to keep up with 70,000 pages. So it's a must that you have a team. And a lot of this tax code discusses regarding small business and how to help small businesses maximize or lower their tax liability. You know, another reason business owners overpay on their taxes is because they are being taxed twice. Now, if you're anything like me, being taxed once is painful enough, and imagine getting taxed twice. Now, don't get me wrong. I don't mind paying my fair share of taxes. I think it's necessary, you know, especially in the country we're in, but being taxed twice is just, it's silly, and it's something that needs to stop, and proper education, proper training will make sure that stops. Another reason, and some of you on this call are probably sole proprietorships, and sole proprietorships, they pay a lot more money in taxes. They also have no protection as a sole proprietor. But did you know that a sole proprietor pays their taxes and then they spend what they have left? Now, corporations are the exact opposite, where you make your money, you spend your money, and then you pay taxes on what's left. Now, I know which one sounds better to me, but I couldn't imagine trying to grow my business and spending what I had left after paying taxes. Now, corporations are the exact opposite, where you make your money, you spend your money, and you pay taxes on what is left. You know, and of course, I know which one sounds best, and we just need to make a simple change in our business and our structure to get to that point. And if you review your structure, it could be maybe going from an LLC to a CCorp or an S corporation, or opting for a different tax selection, which you are allowed to do with the IRS. Some of you may not know that. You can actually change from an S corp to be taxed as a C corp and vice versa. You just have to know how to do that. And by doing that, it will help you save thousands of dollars every year. Now, small business owners who use larger companies just become a cog in the wheel. As I mentioned earlier, there's really no relationship. They don't give the attention your company needs in order for you to grow, in order to plan and become a more solid foundation. Now, a few minutes ago, I mentioned these companies, and did you know in 2015, now in 2014, there were 149,684,000 tax returns filed. In 2015, there were 150,062,000 tax returns filed with the IRS. That's just amazing, 150 million. So roughly 50% of the tax returns are filed by top corporations such as H&R Block, Jackson Hewitt, TurboTax, and others. And so think about this. If 93% of businesses overpay on their taxes each year, then imagine how many are being prepared wrong by them. Now think about that for a second. 90% overpay on their taxes, and these companies are filing roughly 50% of the returns, and that means there's a huge amount of these returns that are being filed incorrectly. Now, I want to share a personal story with you, and it's a personal story that I've come to accept after all these years, but it was very, very frustrating for me. Before I started my own company in 2013, you know, I, like millions of other people, filed my taxes at H&R Block. I thought this would be the best option for me because they had been around for a long time. We've all seen their commercials, and they really made me believe that they were the qualified professionals to go to. Well, I purchased my first home in October of 2008. That year, there was a $7,500 first-time home buyer credit, which some of you are probably familiar with and maybe used, which was supposed to lower my tax liability. Well, what I wasn't told is that it was a $7,500 loan that I would be forced to pay back at a minimum of $500 per year, whether I was getting a refund or not. Now, knowing this up front and having that explained to me, I would not have taken that deduction that year. You know, I was told that the economy was going down. They wanted to see new home buyers, first-time home buyers, and that the president was doing this to encourage people to go out and continue to buy property, continue to buy real estate. I was not told that it was going to be $7,500 in a loan where I had to pay back, and that is still affecting me and my family today. It's a very tough situation. Some of you probably with the Affordable Health Care Act and different things that are passed every single year for you to use as a write-off, have it explained to you. Make sure you know exactly what will take place the following year, and in my case, 10, 12, 13 years later. It's just very important for you to know that and have that explained. And that's why the planning and the relationship is so important for your business. Now, I want to talk to you about how to fix it. So we talked about some of the issues out there. Let's talk about how to fix it. Now, as I mentioned, it starts with your structure. So many clients that I've seen have set up these single member LLCs. They've set up C corporations when they should have been S corporations. Now, before you can determine if the right structure is in place for you, you have to have education. Education comes from proper consulting and having the right team in place to ensure you don't experience some of the pitfalls that I shared with you, that businesses experience, and what I experienced personally. So many business owners are being taxed as a C-Corp when it makes sense for them to be taxed as an S-Corp. Some of them have set up a single member LLC, which is basically saying, tax me like the sole proprietor, please. Well, I shared with you that sole proprietors, they make their money, they pay their taxes, and they spend what's left over. So many people have set up LLCs. They've gone online to set up an LLC with no consulting. They do it because it's more affordable, and they file the wrong election. They're a single member. They can't pay themselves a salary. There's so many different things that being an LLC, especially a single member, can affect you. Now, another reason businesses are overpaying, even individuals are overpaying on their taxes, is the bookkeeping and the accounting of the company is being overlooked. You know, business owners are so busy running their businesses as they should be. You have to do their marketing, you have to do the sales, you have to do everything, especially if you're a startup company. Now, you know you don't have time to play clerk, and you don't have time to do the proper accounting for your business. So instead of hiring the right individual or company to do this for you, they're simply doing nothing at all, or they try to do their own books. They're just inserting numbers, which can actually be worse by not doing anything at all. By doing this, many business owners don't know what their profit and losses are when they bid on a job or purchase a company vehicle. They're going off the balance in their checking account, and many times using that to determine if the company is profitable. Now, let me share this with you. After 10 years experience, I will tell you I have seen in many cases when a client has had no money in the bank, but they were actually turning a great profit because their books were not in order. They thought that the company was losing money. I've also seen the opposite too. This will be the case if proper records are not being kept throughout the business. So you must keep proper records, and if you do, you'll know exactly where you stand. You know, at Corporate Capital, tax planning is our #1 goal. All of our clients not only have their tax preparer and CPA to talk to throughout the entire year, and not just at tax time, but they also have something done in October which is very, very unique, and everyone should be doing this. We know where our clients are at, so we know if our clients need to start putting away money or if they need to start spending money before the end of the year. So in October, we file in-house what I call a dummy return, and others at the company call it a pro forma return. It's probably a little bit more professional, but regardless, we file a return in October so our clients know exactly where they're at. So they have 2 months to purchase, to spend down, or to wait until January 1st to purchase something, or to do it right away. There's planning, and with that planning, you lower your tax liability, and you also grow your company the correct way. And unfortunately, if you hire someone, let's say right now you hire someone in February to do your taxes for 2015, well, once you start looking at the numbers and what your business did last year, if you're not in a position where you should have spent down, well, after December 31st, you can't do that. You can't go back 2 months and make a purchase. So it's really important to start thinking about it in October. And the successful businesses I've seen, they really do that. And I challenge everyone to do that for their business. Now, tonight, I mentioned at the beginning of the call, I have a special guest. Bob Rome is our CPA at Corporate Capital. He has over 30 years experience helping businesses and individuals file their taxes properly. He has experience making sure their records are in order. Let me tell you a little bit about Bob first. Before moving to Nevada, Bob had his own practice in Wyoming and was active in the Wyoming Society of Certified Public Accountants. In 1987, he was appointed by the governor to the State Board of Accountancy for 2 3-year terms. And for 2 of those 6 years, he was actually the president of the board. Now, Bob has a saying here at Corporate Capital, which I think it just makes sense. It's a simple saying. The saying is, you can't manage what you can't measure. So basically, if you have no idea where your books are, if you have no idea what your profit and loss is, how in the world can you know where your business is going in the direction? So I've asked Bob to join us on this webinar tonight to go over some frequently asked questions. Now, on your screen, you'll see some of these frequently asked questions, and I'm sure they're going to relate to all of you. Now, if we did not address one of the questions that you had, based on the information tonight, please go to our website, which is corporatecapitalinc.com. Again, that's corporatecapitalinc.com. And we have a contact us form on, I believe, every page. So if you fill out that form and if you write in your question, hit submit, that will come to me personally. I will look at it and I will make sure that your question gets answered either by myself or someone in my accounting department or even a consultant. But the most important thing is we'll address those questions. And some of the questions that are out there, and the most common one that I've seen in the 10 years is what is the difference between a C Corp and an S Corp? So I've asked Bob again to be on the webinar, and Bob, if you could address that question, what is the difference between a C Corp and an S Corp? I'd appreciate that.
Sure, Brent. Thanks for having me, by the way. I get that question frequently, and you know, in general terms, to me, a C Corp is more designed for larger businesses. I would say S Corps, about 80 to 90% of the corporations, the small to medium-sized businesses that are incorporated are preparing their taxes and have elected to be an S corporation. The most fundamental difference between the C and the S is that an S corporation doesn't pay its own taxes. It flows the income or loss through to the shareholders, and they report that on their individual tax returns. There's also a difference in the taxation of other distributions. For example, distribution from an S corporation is handled differently than a dividend from a C corporation, although the term dividend is used kind of loosely to describe both, and it causes some confusion. Another frequently overlooked issue with the S corporation is that it really is truly designed for small business. You're limited with how many shareholders can participate or own stock in an S corporation, and the type of owners. In other words, an S corporation owner must be an individual, or there are certain types of trusts that can hold stock in S corporations, but LLCs cannot hold stock, C corporations cannot hold the S stock, and foreign individuals cannot own the S stock. So that's something S corporation shareholders have to be, or owners particularly, have to be very aware of. One other issue is can only be one class of stock in an S corporation. In other words, you can't have common stock and preferred stock. That would cause a termination of the S election and could be a tax disaster. So those are some of the fundamental differences, at least. And there's a use for each type. But like I say, the small to medium-sized business is most frequently going to be better served by an S corporation election.
Okay, thank you very much, Bob. Yeah, I get that question quite a bit. And for those of you who want to know, corporate capital, that's how currently I have elected to be taxed is as an S Corp. So it works out for my business. But of course, I sat down with my accounting team and CPA to make sure that that was the right fit. Another question that we get quite a bit is, if I'm indeed taxed as an S Corp, can I pay for my health insurance? Bob, what's the answer to that?
Well, the answer is yes, but you have to be careful with how you treat that. The S corporation can have a plan for its owners or a group plan that includes the owners, but the owners are treated somewhat differently. The premiums paid by any shareholder who owns more than 2% or more of the stock of the S corporation must include the amount of the premium as taxable income on their Form W-2. It's critically important. So first of all, the owner has to be taking a W-2, which if it's a profitable corporation, we strongly recommend that, and the IRS is adamant about the owners taking W-2 income. So first you must take a W-2. Second, you include the premiums on the W-2. What this allows for is that the premiums then are deducted by the corporation, included on the W-2, that becomes a wash, and then the shareholder can take a tax deduction on the front page of their tax return. We call it an above-the-line deduction for the amount of the premiums, called self-employed health insurance. And that's by far a beneficial way to take that deduction than to include it as medical expenses on the Schedule A as an itemized deduction, which is subject to rather severe limitations based on your income. So the answer is yes, but you have to do it correctly to get a good tax benefit.
Well, I appreciate that. I know with health insurance and it being mandatory, that's a very important topic and understanding for your business. So thank you very much. I know that you and I have talked in the past and recently in our conference room meeting, we talked about the extender bill. So I thought that would be a good one to add tonight. So can you explain what the extender bill is?
Sure. For the last number of years, we've had an issue with the gridlock in Washington, D.C., where we don't know what the tax rules are going to be for many items until very near the end of the year, which makes it virtually impossible to do our tax planning with our clients, specifically related to items like bonus depreciation, the Section 179 expensing election, to name two of the most important ones, I think, that influence our small to medium-sized business clients. The extender bill, they've extended them each year, but each year until this last year, they've extended them for 1 year at a time, which didn't do us much good, because in December, we didn't know whether in January the same rules would apply. Now we have a little more assurance. This extender bill extended many provisions, like the 179 election, to make it permanent. Other things, like the bonus depreciation, was extended for a period of time. So for at least the next 5 to 10 years, we have some certainty in what we say to our clients when we plan for taxes. So that's a positive thing. We don't often get positive things coming out of Washington relative to taxes, but this has been a big help. There are many other items that were extended that may or may not affect an individual's return, but the small to medium-sized business, the bonus depreciation and Section 179 election, and which one to use and when to use it are extremely important.
Thank you very much. Yeah, I wasn't quite sure what the extender bill was until we spoke the other day, so I'm sure that was new to a lot of you. Let's carry on. I know we have a few more questions that we're going to answer for our audience tonight. If I'm a single member LLC, can I pay myself a salary?
Well, the answer is a single member LLC does not pay. In fact, any LLC does not pay their members a salary. It's not appropriate to pay a salary. A single member LLC files a Schedule C and simply pays tax on the net income of the business. A multi-member LLC will file its own tax return and flow the income through. Now, there is a provision in it with a multi-member LLC called a guaranteed payment. In other words, if you've got more than one member and perhaps the members don't both spend the same amount of time or don't all spend the same amount of time working in the business, you can compensate that individual with a guaranteed payment, which is different than a distribution of earnings because it can be disproportionate to the ownership. So it's more proportionate to the amount of time spent working on the business. But it is not appropriate for any LLC member to get a W-2. And so they're not paid in the formal sense of an employee, but there is a provision for how to handle that.
Okay. Well, thank you. I really appreciate your time again tonight, Bob, addressing some of these questions. We have a couple more that are frequently asked that again, in my 10 years, have been asked at seminars and been asked with new prospects. And I mentioned it earlier. I talked a little bit about double taxation, which is amazing that it's even possible to happen. But what's the deal with double taxation?
Well, double taxation is a term most frequently used in the C corporation world. And because C corporations pay their own tax, the first level of tax is on the net income inside the corporation. So if a corporation makes a profit, they pay tax on that profit. The money, however, from the profit is still in the C corporation. So the next level of taxation would be getting the money from the C corporation to the shareholders. And that could be done in several ways. Most typically, if the shareholder doesn't work in the corporation, they get a dividend. Now, the dividend is not deductible to the C corporation, but it's taxable to that individual. So you're taking dollars that were taxed in the C corporation, passing it out to the shareholder, and they're taxed again. Now, we do have some beneficial treatment of dividends now, so if you're in a low enough tax bracket, it's conceivable that that dividend would not be taxed, but the theory of double taxation still remains the same. Taking a salary as a C corporation owner would be deductible to the corporation and then includable on the individual's tax return and only subject to one level of tax. Another method that's used frequently is when the C corporation is capitalized. Part of the capital that's put into the corporation can be treated as a loan. The repayment of that loan then, in other words, getting the money back out of the C corporation after the taxes are paid there, would simply be a repayment of principal and perhaps a payment of interest, but not subject again to double taxation. You do have to be careful that you don't, what the IRS would refer to, thinly capitalize the C corporation. They frown on that. But as long as your debt isn't more than 1.5 times your equity, that usually is a rule of thumb and usually will be allowed to stay. So careful planning in the C corporation world can help to avoid double taxation, but not in every case.
Great information. Thank you. All right, moving along. I know the standard deduction is going up every year. Is there anything a taxpayer can do to itemize their deduction?
Well, that's right, and that's kind of good news that the standard deduction is going up every year, particularly as taxpayers get a little older. They're paying down their mortgage. Maybe they've refinanced at some of these attractive lower interest rates, and they're right on the bubble. The standard deduction for a married filing joint return is $12,600 now, and I find a lot of taxpayers, particularly older taxpayers, are real close to that number, at least in states that don't have state income tax. That number can be a little different when there's state income tax involved. Excuse me. But one of the things that we do to plan is what we call we can stagger our deductions. For example, if you tithe or give to your church or charities in reasonable amounts each year, you have the ability to double up one year, wait a year, and double up the next year, and that might push your itemized deductions over the standard deduction limit in 1 year, so you could take advantage of itemizing, and then next year use the standard, and again the following year itemize your deductions. Other types of things that you can time, maybe real estate taxes to some degree, and state income taxes, timing how you pay. If you're paying estimates on your state income taxes, you might pay your January estimate in December or vice versa in order to maximize the benefit. And people who plan carefully can get some advantage of that.
Yeah, that goes back to planning. All right, I think we have one more here, Bob. Rental properties, which is good. When I first started in the business in 2005, I did a lot at the Real Estate Wolf Expos and the Learning Annexes, and that was pretty much the jumpstart in the industry. It was really popular. The economy was good, so there was a lot of real estate LLCs, corporations that we set up. We have a question here about rental properties. So if I own rental properties, what would be the best structure or entity for me?
Well, I think the answer to that is in most all cases, the LLC is the proper vehicle to use. And there are a number of reasons for that. If it's just an individual or even a husband and wife owning an LLC and owning a rental property within the LLC, it's called disregarded entity for income tax purposes. So you save the money of filing the second tax return but still get all the benefits of reporting your rental property on your personal tax return on the Schedule E. Some people own real estate in S corporations. To me, it's not as desirable. It's certainly possible, but they're not nearly as flexible as the LLCs, particularly when you've got multiple members of the LLC. It may not be a husband and wife. It may be family members. It may be one individual is putting sweat equity into a business, another individual is putting cash into a business. The LLC allows for flexibility where that could be made to have some economic significance, or that the IRS likes to hear about, that it could be beneficial for both members in a situation like that. The one entity I would avoid at all costs to own your real estate is a C corporation. Even in the S corporation world, there are issues where it's not advisable. But when a corporation distributes property, for example, it's a deemed sale, so it's reported at the corporate level as a sale at a gain or a loss, and then distributed to the individual against their basis, and perhaps another gain. So again, the potential for double taxation in the C corporation world. One more issue with a C corporation is C corporations do not take advantage of long-term capital gains rates that individuals do. So if you hold a property for a long period of time and sell it in a C corporation, it can be a tax disaster. So I hope that helps.
Yeah, that helps. And just short answer on this one is fine for me. And I mentioned it earlier, was the opportunity to change from an S corp to a C corp, or change the election of how your corporation is being taxed, and that is something that our clients would be able to do if they are holding the property a certain way. Is that correct?
Yeah, I mean, the most typical one that we find is when you initially start as an LLC and for whatever reason decide to be taxed as an S corporation, that there's an election to be taxed as an S corporation that's filed, and then starting the beginning of the next year, you simply file your taxes a different way. So you have to file a separate tax return. But that's relatively common. The one thing that you have to be very careful of if changing entities is those people who might think that getting rid of double taxation, if they have a C corporation, they decide to change that to an S corporation. If you decide to do that, you better get some professional help, because there's something called a built-in gains tax, that if you sell a property that you held in that C corporation within the next 5 years, then this is an issue or a circumstance where an S corporation would pay tax on the gain on that property. So careful planning to change entities again.
Okay, all right. Thank you so much, Bob. I really appreciate your time, and I hope that helps everyone to understand a little bit more about what you can do and what your options are. Also, please know that on our website, we have just launched a brand new website, and on there's a video section, and there's a few videos, I should say a couple of videos that Bob and I have recorded, gone over some other questions that were actually not on the webinar tonight. So visit us on our website and please watch those, and if you have questions, just reach out. I want to share with you, I think it's important to talk about success and to talk about our client success. And Keith Davis is a trucker. He's pictured here on this slide, and that's his truck. On the back of his truck, you'll actually notice we have our logo, Corporate Capital. On the left door, we have Need Business Funding, Build Your Business Credit. We have Protect Your Truck by Incorporating. We actually put that on there for him, and he's an affiliate of ours. We had an affiliate webinar a couple weeks ago discussing becoming an affiliate of Corporate Capitals and how that would benefit you. And every time someone calls that phone number right there is Keith Davis's number. So every time the phone rings, it says Keith Davis, and he gets credited for any new client who comes on board. But anyway, the reason I want to share this with you is because of the quote and the testimonial that he gave us, being a long-term client. You know, he started off as a sole proprietor until he incorporated his trucking business with us. Now we do his bookkeeping and his taxes, and he literally saves thousands of dollars every single year. And he's got a big operation, and he doesn't mind me sharing this. You know, $1.5 million last year, and we just save him a ton of money on his taxes. His company is K. Davis and Associates out of Merced, California, and I think that's important for everyone to know. If indeed you have some challenges and you think your structure needs to be looked at, just know we work with clients in all 50 states, which is great. Most of our clients actually do not live out here in Nevada, so it's great to be able to work with clients nationwide. We have some worldwide, which is great. I want to share with you real quick the audit story there. 2013, 2014, we had a client, I believe in Michigan. He works on helping clean up like disasters, so to speak. He paid taxes, and in 2013 and 2014, he overpaid to the tune of $64,000, 64 grand. We looked at his taxes, redid them, saved $31,000 one year and $33,000 another year. So was able to get back that money and do the tax returns properly. And that audit story is probably the most important to me, to be able to help a client like that, because that is a lot of money to overpay. And his taxes were done wrong. They were filed incorrectly. The accounting wasn't right, and that's what happened. We also have, I don't have it on here, but we had a client out of Colorado who was in the oil business, multi-million-dollar operation, but we saved them $287,000 on their taxes. And again, that they were prepared wrong and incorrectly. So take a look at it. It's your money. You're working hard to grow your company and to make a profit. Robert Dowdy is not only a client, but he's a really good friend of mine. He's someone that I really appreciate, and every time he comes to Las Vegas, he stops by our office. He makes it a point to come by and say hello. And Robert is another one. We incorporated his business, and he wanted to incorporate to protect himself from personal lawsuits. Well, last year he made $192,000, and because of what he says, Corporate Capital's bookkeeping and tax services, he paid $0 in taxes. We also were able to get him $100,000 in credit cards, which has helped him grow his business. Now, I don't want you to think that, hey, I made $192,000 or I made $200,000. I'm not going to have to pay taxes. Listen, every situation is different. So it just depends on what industry you're in and what your structure looks like. But ultimately, if we can get all of our clients down to a zero tax liability, that's great. But it worked out for Robert, and of course, we've been doing his taxes and books now, I want to say, going on 4 years. So he's been a good client of Corporate Capital's. Want everyone to know a little bit more about us and meet our team. That's me pictured on the left, and Ashley Lotting is our president, and Tim Harris next to her is our quality control manager. I think quality control in any company is so important. Your customers have expectations. They deserve follow through. They deserve to have what was promised to them and delivered, and Tim makes sure that happens. And Tim also calls all of our new customers and welcomes them aboard, and Tim just does a really good job following up. And then Bob Brome, who just spent the time with us tonight answering those questions. Bob Brome is our CPA, and he heads our accounting department. That's it for tonight. One thing that I want to offer, I think it's so important for you to know if your taxes have been done properly over the years. Corporate Capital is offering to do an audit and a review of 2014, and we'll even do 2013. I don't mind going back a few years. If we can find something and help you save money and earn the credibility and the relationship that way, we would love to do that. And if not, at least you're getting a second opinion, and we'll tell you that your accountant, your CPA is doing a great job. But it doesn't hurt to have someone else take a look at your tax return. So again, anyone joining the webinar tonight, you just contact me, and we will review your taxes for you for absolutely free. We will not ask you to pay for our time. We will do it. We'll review them, and then we'll give you our feedback. Again, if you had questions that we did not answer, that weren't part of our frequently asked questions, go to our website, listed on the screen there, corporatecapitallink.com, fill out a contact us, and again, those forms come directly to Ashley Lotting and I, and so we'll personally get those, we'll review them, and we'll make sure that you have your questions answered, and make sure that your business is heading in the right direction, and that your personal returns for either you and your wife, or you and your family they're being done properly, and we'd love that opportunity. Really appreciate everyone taking the time out of their day. I know we're busy running our businesses with our families, so thank you so much for being a part of the webinar. Please keep a lookout for the next one. We'd love to continue to have the opportunity to share some tips with you and some tricks and things that you can do to help your business grow and save money. Again, for tonight, thank you so much. We appreciate your time. We'll talk to you soon.